We can get started. So thank you very much for joining. My name is Mark Lamonica. I look after the individual investor business for Morningstar here in Australia. Today, we are going to talk about LICs. So should be interesting. So listed investment companies, talk about some of the specifics about LICs and who they might be right for. Before we get into that, we've got our housekeeping items. So anything that you hear today is general advice. I don't know anything about you, so I can't offer personal advice. For anyone watching over in New Zealand, you can get our FAP on our website, morningstar.com.au. And the New Zealand regulatory authorities would encourage you to speak to a financial advisor if you want personal advice. The other thing is, would love questions. So anyone that wants to send through a question about LICs or anything else, I guess, there's a Q&A and there's also a chat function. If you're on Zoom, if you're on Facebook Live or Instagram Live, just send through the question. It'll get relayed to me. All right, so let's get started. We'll get back into the PowerPoint. All right, let's go through a definition first. So you guys can obviously read what it says on the screen. We'll get into some of the specifics about what this is, but a listed investment company. So number one, it means it is listed. So it will trade on an exchange. We'll get into some of the implications of that. So that is one thing. But basically, this is a professionally managed product. So when we think about active management and passive management, passive following an index, LICs are active management. That means there is somebody, an investor or investors that are out there making decisions what goes into a LIC. The other thing is that these things are structured differently. So if we look at that name, listed investment companies. So we've covered listed, means it trades on an exchange. Investment means there are investments in here. Somebody is making investment decisions. Then companies. Think of a LIC as like a company. And once again, we'll get into the implications, but a company where there are decision makers, not only in what investments go into the LIC, but also what the LIC does with any capital gains or dividends or income that come from those investments. If they distribute them, how much they distribute it. So think of this more as a company than an ETF or fund, which we'll get into in a second. So a LIC obviously has managers, it has a board of directors. Just remember that company piece. A ETF, for example, is listed as a unit trust or is structured as a unit trust. And that is basically just a legal structure that means that anything that the benefit investors in an ETF, just knock out the microphone, hopefully not, that the beneficiaries of, I stopped the video. That's what I did. Sorry about that. The beneficiaries of an ETF are the actual investors that are invested in that. That means anything that ETF generates, and we'll talk about this a lot today, capital gains or distributions, income gets distributed to shareholders automatically once it occurs or on a quarterly basis after it occurs. That's not true for a LIC. The other really important thing that we'll talk about the implications of about a LIC is a closed-end fund. So what that basically means is, like a company, more shares are not issued, and there's no mechanism in place to keep the net tangible assets of the LIC in line with the unit price that's trading for. So once again, we'll talk a lot about this today. But what that means is that supply and demand, just like a share, supply and demand is going to drive the price of a LIC, not the value of what the LIC actually holds. So we can see large premiums or discounts. And what that generally means that it's another thing for you as an investor to consider. We'll spend a little time on that in a second. So that's sort of the basic definition of a LIC, and we'll compare it to ETFs and funds because that's important. Okay, so let's compare them. So anytime you're making an investment decision, you're looking at a couple different things. Number one, you're looking at the underlying investments, the instruments that are being held, whether it's a share or a bond, et cetera. And we've gone through these a lot. That's where you want to make asset allocation decisions based on your goals and what you're trying to accomplish. We're going to talk about strategy and vehicle today because these are both pretty important. So when we talk about strategy, we're talking about active versus passive. So as I said earlier, a LIC is active. Somebody is making a decision for you. The decision that we need to make as investors, whether we're going to pursue an active or passive strategy, is we should look at the characteristics of the asset class that we are investing in. So we're going to spend a little time on this later, but there are some asset classes. So when we say asset class, we mean something like Aussie shares, global shares, emerging market shares, bonds, et cetera. Different asset classes, there are different characteristics of that asset class that make it better or worse for active versus passive investing. So many people think that you need to fall into one camp between those two. I'm only a passive investor, I'm only an active investor, but that's not true. So you can make those decisions based upon the characteristics of those asset classes. The other thing we need to talk about is the vehicle. What are the differences between LICs, funds, and ETFs? Well, ETFs and LICs both trade on an exchange. So what that means as an investor is that you are going to be subject to certain things. You're going to be subject to transaction fees. You buy LICs through your broker, just like you would buy an ETF, as opposed to a fund, which you would typically purchase through a platform or perhaps directly through the fund provider. So what you need to think about is, how are you saving and investing your money? If you are somebody who is still in the accumulation phase of your life, so you are still working, saving each paycheck and investing, then perhaps something trading on an exchange would not be beneficial for you because you are paying constant transaction fees. If you're somebody who is investing a lump sum, then maybe you don't care about that transaction fee. Or if you're investing very large amounts of money. So if your paycheck is very big and you are investing a lot of money compared to what your brokerage cost is, then maybe that doesn't matter to you anymore because it makes up such a small amount of what you're investing. But remember, that is the downside of LICs and ETFs, that you do have these transaction costs. All right, so let's talk a little bit about this active versus passive debate. So once again, active versus passive, two different strategies. Active, someone or something like a computer algorithm is selecting the shares that go into a fund, an ETF, or a LIC. Passive, if you're investing in ETFs and funds, that means you're simply following an index. Let's go through some of the different things we want to evaluate to see if an asset class is something that's appropriate for either of these vehicles. So let's start with the big one. So efficiency of the market. So when we talk about market efficiency, we are talking about how much prices reflect values, which is actually interesting because it has a little parallel with how we want to think about LICs. So how prices affect, or how prices and values interact. If a market is very efficient, that means that we do not see large gaps between the price something's trading for and the value. If markets are not very efficient, then all of a sudden we could see really large gaps. And so if you are an active manager, what do you want? You want large gaps, big swings between the value and price, because that's where you can come in and you can select individual securities and have a chance at actually beating the market. So we'll talk a little bit about how we measure that in a second. But one of the things you always hear is that active managers don't beat the market. Well, that's not true necessarily. It is certainly true in certain asset classes, but it's not true in other ones. So the way we measure this at Morningstar and the way people think about this is efficiency is, of course, there is no right answer. Valuing a share, for example, is a art form more than anything else. You cannot exactly value a share. There's a lot that we go through as investors to try to estimate the value of a share, and we try to buy that with a sufficient margin of safety. But there is no right answer to what the value of a share is. But if we're looking holistically at a whole market, one of the ways we can tell if it's efficient or not is how often do active managers outperform the index. The more often and the higher percentage of active managers that outperform the index means that we can induce the market is less efficient, that there are those bigger gaps between price and value, and that humans or algorithms or anything else has an opportunity of going in there and identifying securities that will outperform the market and creating a portfolio that will outperform the market. So that's how we look at the efficiency of the markets, how we take sort of this academic notion of what it is and apply real life to it. So if we look at different asset classes, we can see that there are certain areas where managers outperform the market. And they're generally asset classes that are less popular. And the notion, of course, is that the more people that are paying attention to a certain group of shares or to a certain asset class, the harder it is for those wild swings in value to occur. So with very, very scrutinized markets, think large cap, so the biggest company shares, so whether that's the US or Australia, so a company or a country where a lot of attention is paid to the share market and the largest companies in those respective indexes, it is very difficult to beat the market. We go back and we look at our active passive barometer report, which measures all these different asset classes, we can see that it's very difficult to beat the market. However, if we move into other asset classes, so whether that's micro cap or small cap shares, listed property, fixed interest, start moving into some of these asset classes where less people pay attention to it, we can see that active managers actually outperform on a percentage basis. So every 6 months we go and we create this active passive barometer report where we go back and we look 10 years into the past and see what percentage of managers outperformed that in that respective asset class. And that gives us an idea of where we might want to use active management. So what is the implication for LICs? Well, LICs are actively managed products. So we want to look for managers and look for LICs that are investing in less scrutinized asset classes. So once again, think small caps, micro caps. Now, one of the problems is if you look at a lot of LICs, a lot of them are not doing this. A lot of them are, in fact, investing in like large cap Aussie shares. So just be careful about what that is. The fee hurdle. So the fee hurdle, of course, for actively managed products is a lot higher because actively managed products have higher fees than passively managed products. Once again, we are looking for outperformance after fees. We'll get into, I'll say a shady way that a popular local manager looks at performance. We'll get into that in a couple of slides. So just remember that from a fee hurdle perspective. And LICs do have high fees. So certainly in general, fees that are up there from an active management perspective. A lot of them also have performance fees. So be very careful about those fees. Look at the way that they're calculated. Something else we'll talk about a little bit later. All right, how representative is the index? So basically that means that if we are a passive investor, passive investors, of course, we follow an index. So it's important to look at that index and look at how representative it is of the entire universe of securities that can be invested in. For example, if we look at large cap US stocks, there's the S&P 500. That is very representative of the biggest shares in the US because it is literally the 500 biggest shares in the US. So that means that if I'm a manager and I'm looking for large cap shares, if I'm a large cap active manager, that is the pool that I'm playing in, that 500 shares, and the index covers the whole thing. However, if I'm a fixed interest manager, there are trillions of dollars of bonds out there. If I have a pretty wide mandate, there are all sorts of different bonds I can choose from. So basically, I have a bigger sandbox to play in than the index. So that means, in theory, I should be able to go out there and find securities that don't necessarily conform with the index. It gives me a chance to outperform. That's how representative the index is. And then we also have to think about asset liquidity. So basically, liquidity is just how quickly and easily you can take an asset and raise cash for it. So something's very liquid means I can sell it really quickly. If something is not liquid, it means I can't. So like your house is not liquid because even though once it actually goes up on auction, it'll probably sell pretty quickly. It takes me a while to get the cash because I have to go through that whole escrow period and everything else. So your house is not liquid. Shares are very liquid. So anytime the market's open, I can sell them and get my cash pretty soon. But if we look at different types of shares, some are less liquid or more liquid. The less liquid a share is, the less buyers and sellers are out there, which means that if I'm going out there and I'm buying particularly a large block of those shares, I can move the market, right? So if we think about how a market works, there are asks and bids. So basically asks are people looking to sell, bids are people looking to buy. If I put in a large order and you look at the market depth, literally my order can keep falling until it hits somebody that is willing to pay for it. Now that can only be a couple pennies, but think about what happens when an index is rebalancing or adding a new security. Active managers have an advantage when a market is not very liquid. So once again, small caps, micro caps, emerging market shares, things like that. Active managers have an advantage because they don't have to go out there and buy something. And they don't have to go out there and buy that immediately, which is what an index needs to do because they need to represent that index. So if there's a change in the index, they need to go do that. Active managers don't have to do that. So that gives them more of an opportunity to take a step back and think about, okay, what are the trading implications of getting a position in this? And how quickly do I want to do it? And if market's not very liquid, they can do it very, very slowly because they're not following an index. So all things to think about. All right. Okay, so got some good feedback from Dennis. So he's been researching ETFs in Morningstar. I think you should add the ASX code and the net asset value, so it's all there in one place. So we do have the net asset value, which I'll show you in a second, Dennis. But yeah, thank you for that feedback. All right. The other thing that we need to, of course, decide, and this is what I alluded to earlier, is what sort of situations do LICs make sense in? So LICs and ETFs are very, very similar till we get down to the valuation method, which we'll spend some time on. So once again, if you are going out there and you are making lots of small purchases of something, every paycheck, you purchase a small amount of ETFs or LICs, the brokerage is going to start to add up. So you're going to pay a lot in brokerage cost. You're also going to have potentially, if these are smaller lots that you're buying, just think about that if I'm spending $20 on brokerage, every time I go out there and invest $500, that's not great for me. That's a huge hurdle that I have to overcome before I make positive returns. But this varies significantly, right? Because different platforms, of course, cost different amounts of money to trade. So this is all, and we're all trading in different lots, depending upon how much money we have. But just think about transactions. Whether you're one of these dollar cost average investors or you're somebody that's going in there and investing a lump sum. If you're investing a lump sum, ETFs and LICs probably don't matter. Management fees, yeah, you're going to pay more for a LIC generally. Valuation method. Let's spend a couple minutes on this and we'll talk through each one of these. So net asset value or the net tangible asset, and there's reasons we have different names for them, basically just represent what is within this investment vehicle and what it's worth. So let's start with funds. So for a fund, at the end of every day, there is a team of fund accountants that go in and value that fund. They will look at every single thing that's held in that fund, all the different shares and cash and anything else that might be in there. They will put a value on it, and then they will strike a NAV. They will strike a net asset value. And it is that net asset value that everybody who wanted to buy into that fund that day or sell out of that fund will transact at. So we know, and there's a little bit of a buy-sell spread, but everybody knows that is what we're transacting at. We are transacting at the value of the fund every single day. ETFs, once again, just like everything else, a basket of securities. Now, in this case, the net asset value is getting calculated continually across the trading day. So every 30 seconds or so, they are striking another NAV and recalculating what this thing is worth as if we're calling it, if it's an equity ETF, as those shares fluctuate in value every day. So they're continually doing that. But the NAV is not the price that you are necessarily getting as an investor. Because an ETF trades on an exchange, and like anything else that trades on an exchange, it is going to be influenced by buyers and sellers, supply and demand, just like a share, just like a LIC. The difference is with an ETF, a mechanism has been put into place, which I can explain, but a mechanism has been put into place to try to minimize how much that ETF, what the variance is between the net asset value, the value of the assets in there, and the unit of the ETF that's trading. And basically what they're doing is as demand increases, if there's a lot of buyers out there trying to buy this ETF, they have a mechanism in place where they will just issue more ETF units. And basically the mechanism, it's something called creation baskets, that there are investment banks that are called authorized participants, and they obviously do this all computerized. If they see deviations, if there's lots of buyers for an ETF and it pushes that ETF unit price up higher than the net asset value, then they will come in there and arbitrage away that difference. So arbitrage is just a term for a riskless profit. And what that means that they will do is if the ETF unit price is higher than the securities in it, they will buy the ETFs, break them apart into their constituents, and sell all their constituents. And they do this all instantaneously, right, through electronic trading. So that will remove ETF units, so there's less units available, and bring that price back down. And same thing, if the price falls below it, if there's a discount, then they will do the exact opposite. They'll go buy all the shares in the ETF and they'll trade it for more units. So that increases the units and brings it back up. It's a little bit of a complicated concept, but I think it's worth explaining. So basically, market participants all day increase and decrease the number of ETF units in response to investor demand. Now, this is not perfect, and there are gaps. And depending upon the ETF, there can be bigger gaps, depending upon how difficult it is to go out there and buy all the assets, for example, things like that, depending upon where you are in the trading day. So generally, it's not a very good time to buy an ETF at the beginning of the trading day, because that's when there are larger deviations. But in general, an ETF will be pretty close to the value of its assets. So let's talk about LICs. So LICs, once again, they trade on an exchange. But there can be large variances between the value of the assets in the LIC and the LIC price. And the reason for that is because they do not have this mechanism that ETFs have. They're a closed-end fund. So that means in general, they do not ever issue more shares into the LIC. So if there's a lot of demand for a long period of time, you can get huge premiums. Same thing with discounts. So remember, that makes LICs very, very different, which means we have to consider a couple things as investors. One, because it's an active manager, we do have to consider who are the managers, what is their track record, do we think they can beat the market? Do we think they can beat a passive ETF that you could go buy, for example? And the other thing we have to look at is how do these discounts and premiums change over time? So one thing that people always talk about with LICs is I think people like them because you can go buy the LIC at a discount. I think that makes people feel really good. But you should just know that there's nothing that means that discount will ever change. In fact, that discount could get greater. So it's just another dimension that we need to think about with investors. And one sort of aside around LICs is a lot of LIC managers have basically gotten fed up with this. So we've seen a couple of them convert into managed funds or ETFs. Basically, they were sick of trading at a discount. So they just said, okay, we won't do that anymore. We'll convert. And then we've also seen, we'll talk about Wilson Asset Management in a second, but we have seen Wilson, so Jeff Wilson, who you may remember from the franking credit debates around the last election. So Jeff Wilson is a huge proponent of LICs, and he and his firm have come out and they have started basically a LIC that buys LICs. It tries to kind of take over LICs and end that discount. So he's sort of trying to take advantage of those large discounts that they're trading for. So we'll actually have, and you'll be hearing more about our conference coming up in February, but Jeff Wilson is one of the speakers. You can come hear from him himself. All right, so let's, we've got some questions. Okay, so Phil's talking about rebalancing and any inefficiencies that occur. Okay, so a couple different things. Let's talk about rebalancing for a second. So yeah, rebalancing is, of course, if you are a passively managed, well, there's two different kinds of rebalancing. Let's talk about sort of forced rebalancing. If you are a passively managed ETF or fund, you will rebalance periodically. Now, you'll rebalance for a couple different reasons, because the rules of the index, well, basically the reason is the rules of the index tell you that you have to rebalance. So I'm trying to think of a good way of explaining this. There are indexes and there are indexes. So one of the crazy things about passive, this is a little bit of an aside, is that a lot of these thematic ETFs that have been started are technically following an index, but they're very screwy indexes that have a lot of rules. So the example I always use is the FANG ETF. So the FANG ETF has 10 securities. It's following this made up index. I mean, they're all made up, but this ridiculous index. And that index has quarterly rebalancing because it has 10 securities and the index rules say they have to be equal weight. So on a quarterly basis, rebalancing will occur. If the market's gone up, the winners will be sold, more money gets into the losers. So simple example, the best performing of those 10 shares in that ETF is 15% of the portfolio. The worst performing is 5%. They'll sell the 15, buy the 5 to get everything back to 10% each. Right. So there's that rebalancing. So that's really bad for shareholders because that rebalancing incurs capital gains that automatically, right, because they're unit trusts, they automatically get pushed down to you. And then if you are following an index like the S&P 500 or the ASX 200, really what you're worried about there, because it's market cap weighted, not really worried about rebalancing. What you're worried about is when the index constituents change. So the ASX 200 is the 200 biggest securities, biggest companies in Australia. So if the 201st gets bigger, all of a sudden it's in the index, you need to sell something out of the index and buy that. So that's the other thing that happens. If we talk about LICs and we talk about active managers, rebalancing is just something that the manager decides to do. Just like you could rebalance your portfolio because something's done really well and is making up a huge amount of your portfolio. So for a LIC, the manager would do that. And what we'll get into in a second, and I see some comments around this, what we'll get into in a second is the manager does not have to pass those capital gains on to you. They get to choose when they do it, and they, in theory, can retain them forever. So we'll talk about the implications of that, but that's the rebalancing. So like Ann's saying, for self-managed super fund, 100% pension mode is an ETF a better vehicle from a tax perspective than a LIC. Give me a second. We'll talk about that on the next slide. The taxes are different. Yeah, so Paul's saying, can you comment on LIC performance fee? So basically, and we'll talk about that in a second too. From experience, it seems a minefield in choice of benchmark and time frame. Yeah, so there's a lot of controversy, particularly around the way Wilson Asset Management deals with performance fee. So I will get to that in a second. So Paul saying, doesn't discount to NTA mean an arbitrage opportunity? It seems too good to be true. Unfortunately, it doesn't, because the problem is that discount may never go away, right? So when we're talking about the arbitrage opportunity that we have with ETFs, it's because they have this mechanism where, simplistic example, if there are 2 shares in an ETF. So an ETF holds CBA and NAB. I can continually, as an investment bank, exchange those 2 shares for a unit of the ETF and vice versa, and then sell them, right? So if the ETF is worth $100, and I'm using an extreme example, and the CBA and NAB shares in there are worth $50. So that's a great opportunity. So I buy the $50 and I exchange it for the $100 and I sell the $100 in the open market. So that's that riskless profit. But you can't do that with a LIC because I can't get my hands on what's in there unless I buy the whole thing. So like in theory, if a LIC had $100 million of assets and it was trading for $25 million, in theory, I could go out there and try to acquire every share on the market and then sell the $100 million worth of goods. And that's basically sort of what Jeff Wilson's trying to do with his new LIC, with the ticker symbol WAR. So he's going to war on discounts and premiums. Okay, good question by Eric, which we'll get to. Does a LIC usually include reserves in their NTA? Yep, we'll get to reserves in 1 second. How does the NAV differ from the NTA? Basically, because they can include other things like reserves is the answer to that, Dennis. So it's more terminology, but you have to think of a LIC as a company, right? And so here we'll talk about the specifics, and then we'll get into how this stuff works. Well, let's go on to the next slide. And this should help you. Okay, so if we think about a LIC as a company, let's think about what a company can do. And not a bad example of this is if you look at Berkshire Hathaway. Now, Berkshire Hathaway is not a LIC. It's nothing to do with being a LIC. But think about what Buffett has done. He's built this sort of portfolio of companies. Some are publicly traded, and he just owns some shares in them. Some are wholly owned subsidiaries. But that's really what a company is in general, right? A company could have different business lines, and a company could own traded securities. A company can do all sorts of stuff. Now, as those business lines or traded securities make money and pay money back to the company. So with securities, that would be dividends, right? So if I own a bunch of shares, as they give me dividends back, I can make a decision as the management of that company what I'm going to do with those dividends. So one thing I can do is I can just keep them and they can pile up in cash, right? I can keep a bunch of undistributed capital gains because we're talking about taxes here as well. So those are things I've sold where I've made a gain. I can keep those, or I can return them to shareholders if I'm a company, right? I can pay out a dividend. LICs can basically do the exact same thing. So what that allows LICs to do is build up reserves. And these reserves of capital gains and dividend distributions are unique when we're looking at other securities. An ETF has to pay them out. So an ETF on a quarterly basis is just going to pay you out any income that's earned or any distribution. So they can't reinvest that income. They can't decide like you could in your own account. They can't go out there and set up a dividend reinvestment plan and reinvest that income because it's a unit trust with you as the beneficiary. They have to pay all of that out. So what you tend to get with ETFs, and that's what this example is, you can see income bounce around a lot. It can bounce around as the income in the companies that are held in the ETF fluctuates as dividends are changed. And it fluctuates because of capital gains distributions. So the market's going up a lot and they're rebalancing or they're adding new constituents, then you're going to get a lot of capital gains. And those are going to be passed off to investors. So those distributions, the reason we call stuff that comes out of an ETF, the reason we call them distributions and not dividends is because they also include capital gains. LICs, because you can build up reserves, and the reserves are generally published. You can go see what the reserves are. Because you can build up these reserves, it gives the LIC manager the ability to smooth out that income because they can decide, okay, well, this year, we're going to keep some of these reserves. We made a bunch of extra money, we're going to keep some of those reserves and basically save them for a rainy day. Then we'll distribute them later. So what we have here is we looked at 2019 and 2020. So obviously not a great time for markets and not a great time for dividends because a lot of companies suspended, cut, you name it, eliminated their dividends during 2020 because they were very worried, obviously, about what was happening with COVID and the economy, and they wanted to reserve cash. So not a very good time to be a dividend investor. But if we look at some LICs on here, you can see that there were not giant differences in distributions, right? Because if we look at just ordinary distributions and special distributions, you can see the differences, not huge, or we had huge differences in ETFs. So basically, these things are reflecting a falling market, lower income. So if you are a retiree, and you are living off of the income from your portfolio, this is not good, right? So we're talking you need to spend 50% less if you don't have other cash reserves. This, not so bad, right? So a little bit easier for people to stomach. So this corporate structure of ETFs and LICs means that if you're looking to generate income, that isn't a terrible thing for you to invest in a LIC. Now, remember, this is, if they're dipping into these reserves, that is just incoming capital gains that they have saved from previous years. In theory, you could do the same thing if you're disciplined, right? That if you're getting paid out, dividends are unusually high, you could just reserve those for a rainy day. So you have the same ability to do that. But it's one of the reasons why people really like LICs. So yeah, something to think about. Now, one thing that's happened with LICs lately is, for some unknown reason, when traditionally financial advisors would be paid commissions for certain products. So if they push their clients into a certain product, they would get a commission from the fund manager. For some reason, when those were banned in Australia a while ago through the FOFA Acts, LICs were not banned. So LICs were still able to do this till last year, which was interesting. So one of the reasons why people say that there's been bigger discounts to LICs is because when financial advisors were no longer incentivized to put their clients in it, they didn't put their clients in them. So something to think about with LICs. I thought I would add there. All right. So let's talk a little bit about Wilson Asset Management. So as I said, Wilson Asset Management and Jeff Wilson was heavily involved in this sort of the fight against labor's franking credit policy, whatever you think of that, in the last election, and a huge proponent of LICs. Now, there's a couple things you need to watch out for if you're investing in any of the WAM products. So number one, performance fees. Let's talk about how performance fees work, because we had a question on that. So a performance fee means that you will generally have, the way fees work, so you'll generally have sort of a set fee that you pay. Just for simplicity's sake, let's say it's 1%. So that means every year you will pay 1% of what you've invested in that LIC in performance fees. So that goes to the management company. If it's Wilson Asset Management, it goes to Wilson Asset Management. It's paying them for managing this LIC. The other type of fee that can sometimes be used is a performance fee. So what a performance fee does is it looks at, and things can get very complicated, but a simple example of performance fee, that if I am managing large cap Aussie stocks in Australia, and I say the benchmark that I'm managing against is the ASX 200, basically means that if I outperform that index, then I get to keep some of that, because the whole point What you're paying me to do is to beat that index. So if I have a 10% performance fee, it means that if I outperform the index by 20%, I'll take 10% of that myself, right? So I'll take 2% of that, 20. So performance fees have always been used with hedge funds. So you always hear about hedge funds 2 and 20. So 2% is the management fee. 20% means that they get to keep 20% of the upside outside of an index. The way performance fees work almost everywhere is that you have a look back period. And what a look back period means is that it makes sure that you are basically not robbing your clients. Whereas if my fund went down 50% last year, and then I beat by 10% this year, I probably shouldn't get a performance fee, because we want a longer look back period so that my outperformance has to be over a longer time period, because basically you're screwing an investor the other way. Well, that's and most funds use a 5-year period, right? So they're trying to make sure that managers, and that's why a lot of people close hedge funds if they underperform, because they're like, we are never going to get back above our break-even point to earn performance fees. Wilson Asset Management doesn't do that. So they have a 1-year look-back period, which is really bad. So the example, here's a simplistic example that I wrote down. So let's say the ASX is flat over a 2-year period. All right. So for year one, the net tangible assets were $100 and they went down to $95. Right. Well, okay. It went down. I didn't beat my benchmark. There's no performance fee. Let's say the next year, and the ASX is just flat. Both years it's flat. But the first year, the LIC goes down $5. So I did not beat the flat index. Index was 0. Mine was negative. The next year, it goes back up $5. And all of a sudden, it's at 100. The index is still flat. They would charge you a management fee for that second year, a performance fee, which is ridiculous, right? Because as an investor, the index didn't move over a 2-year period, and the net tangible assets didn't move. That's why we want to use look back periods. So Wilson doesn't do that. The other thing that Wilson doesn't do, which you need to be careful about, is that they do not report fee. They do not report performance, including expenses, fees, and taxes. Everyone else does that. That is like industry standard. You do not present performance because you are, it is not being transparent if you don't present performance without looking at your own fees that you're charging and any expenses and taxes that get paid out. So that's the other thing that people are concerned about with Wilson Asset Management. But you'll see Wilson all over the place. They're actually trying to take over a LIC right now, and there's been a bunch of publicity because basically the LIC is fighting the takeover and citing all of these things and wrote this huge it's hard to describe it in any other way than a manifesto on all the things that Wilson does that's shady, as a way of trying. Thank you guys for joining. So a couple things. Number one, you'll start seeing more stuff around our conference. So 3rd of February in Sydney. We've got online options as well, if you would like to watch from the comfort of your own home. A couple other things. We did send out a new webinar email this morning. We've got one coming up, not next Tuesday, but the Tuesday after that. In the evening, we're going to talk about this new report, or I'll talk about this new report that Morningstar put out. So it's at 6 p.m. Sydney time. It's a report looking at withdrawal rates in retirement. So I think it's pretty interesting. We put some stuff up on our Instagram account about that. You can follow that as well. If anyone wants a copy of that report, go check out our Instagram page. You can send us a direct message or email me at mark.lamonica1@morningstar.com, and I will send that along to you. So thank you guys very much for joining, and I'll be back on Thursday talking about investing myths.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.